How are you today?
I'm great, Matthew. How are you?
I'm excited for this conversation. I have to admit, when I was doing a little bit of research on you, the list just keeps going. I mean, I feel like Wikipedia was running out of space for all the things here. I mean, granted, I saw that you kind of got in the world of Wall Street. It seems like you got your start with Goldman Investment, and I'm sure we're going to have some great questions about that. Right now, founder of Skybridge, but beyond there, some cameos in movies, some reality shows. You had a small stint as the White House Director of Communications, like kind of all over. Like, I think this is going to be a really fun talk.
Yeah, I got fired from that one. But yeah, no, I'm happy to talk about anything you want, man. I like your backdrop, by the way. Very cool.
I appreciate it. Yeah, this is so just a little background on me and the community here. Kind of all got going with the craziness of GME in 2021. So like when that was going crazy in January, and the day that it really started going, I was wearing this crazy duck shirt that I found for like $2 at a Goodwill store when I was in college. Like I had to go to one of those parties where you just wear crazy stuff. So I had this duck shirt, and then ever since then, it's become, as you can tell, very duck based in my current brand. But kind of with that, of where this community is coming from. Like, so retail, whether they're traders or investors, trying to learn a little bit more about Wall Street. At first, people were very, very excited because it was the pandemic. They had the stimulus checks and things were ripping and they were making money. They felt like they were getting financially ahead just a little bit, maybe for a lot of people, like their first break. And then all of a sudden, particularly on Robinhood, I'm well aware, not on all brokerages, they took away the buy button. And then from there, it kind of went from this David and Goliath story of excitement into like now kind of anger and trying to really dive into what's going on with Wall Street. So, and I know this is kind of tough and maybe from like a high level point of view, but just with your, I guess, history in Wall Street, to someone who's like a new retail trader and or investor, what's the best way to get going? Like, what would be your major tips if you had to talk to your young self of here's how you can be successful in the world of the markets? How would you get that first foot forward?
So, I mean, listen, it's a great question, but everybody's got different skills, right? So someone like Steve Cohen, who now owns the New York Mets, 35, 40 years ago, he was a phenomenal day trader. He had great skills in terms of reading the tape and understanding where trends were going, and he was buying and selling things and made himself a fortune. There are other people that don't have the temperament for that. So I think it's hard for me to just say, okay, here's a specific thing, just do this, and then that's it. I think you have to really be self-aware. You have to know what your skill set is. And so my skill set was being a long-term thinker. I was able to withstand the heat, if you will, in volatile situations. And so I looked at the markets. I said, okay, 80% of the time the market's going to go up. I'm going to put money in the market regularly. I'm not going to trade it. If I earn $1,000, I'm going to put $100 in the market every single paycheck. And so that's what I did. And so lo and behold, what ends up happening is you start to get capital accretion, and then you start to get the compounding effect of the capital. And then all of a sudden the market cracks and you lose a piece of your money, at least mark to market, but and then it goes back up. And so for me, my recommendation to people is to think long-term and to always pay yourself first. So I don't care if you're making $50,000 a year, $100,000 a year, whatever the number is, on your net pay, take 5 or 10% of it and put it in the market. And I'm going to tell you right now, you do that, you'll be well ahead of 99% of the people.
Yeah, I think we've all seen those graphics of like the earlier you start to slowly invest, just like I believe Warren Buffett even said the eighth wonder of the world is compound interest, of slowly, surely getting yourself in there. And
no question.
Off of that, like in retail, I think I see it quite a bit of people, and I'm sure you've seen it more of just on the world of Twitter, especially through the lens of crypto, of people panicking when it's red, red, red. But in reality, it's one of those like Monday morning quarterbacking type things where you're like, oh, I wish I bought there. People are so much more emotionally excited to get in when things are ripping, i.e. more expensive, when in reality, you almost want to do the opposite. And out of just my own curiosity, like I see that in the world of retail. Is it the same thing with like, let's just say like the big guys, like the big money on Wall Street? Do they still have that same human emotional downfall, let's put it?
It's a great question. So I would say on the margin, they smaller people do, but the larger people don't. So somebody like Ray Dalio is worth $20 billion. And let's say he lost 50% of it. He's now worth $10 billion. It's not really going to affect his lifestyle. So I think his temperament has probably been tempered by his net worth and his financial independence. So my thing is this: you have to be trained to do this. So if I took you to Paris Island right now and you had no military training and we were now going to train you to be a U.S. Marine, it'll take 8 to 10 weeks to get you through basic training. And your flight or fight response is going to be very different day one than it would be 10 weeks later. So if I'm shooting at you, you're running. By the end of the 10 weeks, if I'm shooting at you, you're running towards the bullets. Okay. And I use that analogy because that's Wall Street. You get started on Wall Street, the markets are crapping out. Oh my God, I'm going to lose everything. Let me sell at the bottom. Oh my God, everything's going to the moon. Let me buy this thing at the top. I don't want to miss it. And everybody has a little bit of that emotional twinge. The markets will test your mettle. They will test your emotional temperament. But I would say this, and this is something I've been very lucky with. I have the temperament to stay in there. I have the temperament not to look at the near-term noise. Things like Google and Microsoft, as I'm talking to you, are down 16% in the past 13 days. It's like a virtual wipeout. It's almost like a mini bear market in those names. Yet I look at Google and Microsoft, and I'll ask you this rhetorical question: will Google and Microsoft exist 5 years from now? So we both know the answer to that is yes. Will they be larger or smaller companies 5 years from now? So my bet is they're going to be larger. My bet is that they're super sophisticated. They've got deep businesses, unbelievable brand names. They'll end up being larger than they are today. So why should I get trapped into the short-termism of the negativity that's going on in the marketplace right now?
I definitely agree with you. And I feel, and please correct me if I'm wrong, it seems like you apply that type of analysis to many things. Like you're very much heavy into classic Wall Street, but also obviously with alternative assets such as digital assets like Bitcoin, Ethereum, Solana, Algorand, that type of stuff. So with this, I mean, I do want to talk, I know you don't like to get into the nitty gritty of like the short term, like you have more of a multi-year outlook of, it seems like, a lot of your investments. So even with this, though, like, are you still actively paying attention to like what's going on with like the Fed from like meeting to meeting? Right now, we're actually talking at a very interesting time. Earlier this morning, I believe the SPY was actually officially in bear territory. It's down like almost 19 point whatever percent on the year. The Nasdaq is down, and obviously that's dragging a lot of like Bitcoin with it. So like right now, it seems like we're running into serious headwinds. Like the CPI data came in hot, came in at 8.3. We were expecting 8.81. We're going into the FOMC meeting next week. Like, even though you have this long-term view, like, are you using short-term developments to decide when to buy more? Is that kind of your thing of like, okay, we're trying to bottom tick as we add to the portfolio?
Yeah. So, I mean, listen, those are great questions. I mean, yes, but here's what invariably happens, because I have investors, and you mentioned the whole spate of them, retail, institutional, otherwise. And so a lot of people don't like buying bottoms. It's not like chop meat in the supermarket. If it goes on sale, people go out to buy it. If you have apparel, men or women's apparel in a department store, it goes on sale, people go out and buy it. But when stocks go on sale, nobody want to own them. They get very, very frightened. So I'm not incrementally buying right now because, frankly, we're not raising much money. The irony is, our performance will get better. We'll start raising a lot of money, and we'll be buying at worse prices than the prices today. But again, it's a long-term discipline. You just mentioned the CPI number was bad. We had the worst drop in the markets on Tuesday, I think, since the pandemic started, and it was one of the more historic point drops. Maybe it was in the top 10 in terms of the number of points that the Dow lost. But okay, so that happened. Things are negative right now. The Fed is raising rates. There's inflation. We're likely going to go into a shallow recession. So what should we do? Well, selling to me is not the answer. sitting in there and buying quality or staying in quality and being patient, I think is the best thing that people could do. I always tell people the sell-off in Amazon, which was totally unwarranted, it went from $116 to like $8. I was down 90 plus some odd percent. And people wrote off Jeff Bezos. Well, he ended up shooting himself into outer space. And on a second flight, he took Captain Kirk with him. So, I mean, my point is, don't dismiss quality. See through the short-term negativity. And if you're capable of doing that, you come out on the other side. People will be like, somebody's going to say, wow, I could have bought Bitcoin at 17,000. Why? Or 18,000. Why didn't I do that? Well, the conventional wisdom, the conventional financial journalists, some of the old-time punditry was very negative on it. And so I didn't want to be looking like a fool buying Bitcoin at 19,000 because those people said it was going to zero. And so when Bitcoin's trading at 100,000, there's going to be a lot of people saying, wow, that opportunity was right in front of me. I could have bought as much of that as I wanted at 20,000, but I didn't have the strength to do it because of fear. And so I think a lot of Wall Street, a lot of investing is fighting your fear, also dropping your self-consciousness. You don't want to look bad and you don't want to embarrass yourself. I think that drives a lot of decision-making. But truth be told, if you do your homework and you're patient, you're going to be well ahead of the game.
Yeah, I think that's definitely phenomenal advice. And it just seems to be mimicking a lot of people who have had storied careers within the market. Back a little bit to like just the recent CPI and the FOMC meeting next week. And you brought up your opinion is that we might go into a shallow recession. That seems to be a big thing, at least in financial media right now. It's like, it seems like half the people are saying, nope, the low of June is going to be the low of the year. And this is probably a good opportunity. And then you have other people saying, this actually could get more painful. Now, obviously, neither of us have a crystal ball. I wish we did. In your opinion, though, do you think the odds are higher or lower that like is the low in for the year? Like if you had to like, what's your best opinion on that June low? Are we going to be testing it? Or yeah, like I get it. Like we were at 9.1 and inflation, it came in hot, but it is trending down a little bit. So I guess what camp are you in?
Well, I'm in the, I think we hit the low camp.
Okay.
I could be wrong. I'm not smart. Ray Dalio was calling for a 20% drop. Mm-hmm. He's a lot smarter than me. There are other pundits, Jeff Gunlock, he's calling for a 20% drop. I think the chief strategist at Guggenheim is also calling for a 20% drop. So they're probably smarter than me. So I'm not going to sit here and tell you that I'm right. I've been humbled by life. I've been humbled by markets. I don't ever speak in certitude about markets, but I can tell you that I think that the low is in place because the trends that you're just describing are going in reverse. So the inflation number is coming down. The energy number is coming down. The raw commodity numbers that go into the economy are coming down. The disposable income is actually trending up. The consumer is actually doing pretty well. The savings rates are high. There's a lot of pent-up demand as a result of the pandemic. And so the collision of those two things, I think, are going to surprise people to the upside. But I could be wrong. I mean, listen, there are smart guys out there calling for a 20% drop in the market from here. But here's what I would say to you. Let's say they're right. So what? Let's say I put $1 into the market. It's now worth 80 cents. Mm-hmm. But the market bottoms down 20%. Well, historically, we have 50 to 100% rises from the bottom. So if I put $1 in the market and that dollar becomes worth $1.60, am I ahead of inflation? Am I ahead of the game? The answer is yes. So again, it depends on your time frame.
Gotcha. Yeah, I mean, there's some sort of stat out there that like per year, if you're trying to time it, if you miss like 10 of the best days, instead of an 8% return, it drops to 2 or something like that. It's just the math tells us it's better to just be consistently in and in and in. But right now, I mean, I think people...
I think that not to slow this down, but I want to reemphasize that. I want people to really think about that. So I'm an investor. I'm trying to guess things. And as a result of that churn, I'm causing myself commissions. And if I miss the 10 best days, I've lost all the juice in my return. So isn't it just better to put the money in and turn the computer off? You know who the best performing accounts are at Charles Schwab? The dead people. Okay, the dead people are the best accounts. You know why?
I never knew that.
They don't get Matt, they don't get emotional about their investing. They're dead.
Wow.
So they just keep the money in, and the money go Google it.
Wow.
Dead people's accounts,
it makes sense. I just never, wow, that's actually a really impressive
people
stat.
do better than living people because
Wow.
they're a little less, the dead apparently are a little less emotional about their investing than the living. So,
yeah.
Anyway.
Seems to track. Obviously, you're very much in the world of crypto, and I believe one of the Winklevoss twins was just trying to tweet about this recently. And cards on the table, I'm invested in Bitcoin. It's one of these things where it's one of my highest conviction plays for multi-decades out. But I think we could have a good discussion of right now, if it is pitched as digital gold, if it's pitched as an inflationary hedge, well, why is it more correlated with the NASDAQ than opposed to going the opposite way of inflation?
Again, these are great questions. So let me try to frame this for you to the best of my capability. I think the inflation hedge arguments related to Bitcoin specifically are going to be right, but they're not right today because Bitcoin is not fully adopted. So if you said to me, there's a billion wallets or 1.5 billion wallets of Bitcoin, then all of a sudden it becomes more stable. Let me go back to Amazon. Let me use that example quickly. If you looked at the volatility of Amazon the first 15 years, quite volatile. It slowed down, and as recently as the last 2 years, it's one of the least volatile stocks in the marketplace because it's institutionally owned, and so there's sedimentary activity there. But as it was becoming Amazon, it did this. This sort of wave of volatility. So to me, I think you're going to be right about inflation hedging with Bitcoin, but just not yet. It's just not big enough yet. It's not scaled enough yet for that.
Do you think it's one of those things that the SEC just needs to give us the green light with like a spot ETF? Like, do you think that's going to be a major thing, signaling to the market?
Yeah, that would be super beneficial, but the current SEC is really being run by Elizabeth Warren. And so Elizabeth Warren, for whatever reason, I think she's probably the stupidest, smartest person I've ever met in my life. She really doesn't understand it, or she doesn't want people to get rich from it. I don't know what it is, because Bitcoin helps the unbanked. And Bitcoin, if you're a progressive, it's a great thing for people that don't have access to the banking system. Mm-hmm. Yet she hates it. And I think she hates it because people like Mike Novogratz have gotten rich from it, and she hates that.
I've heard some rumblings, and please correct me if you've heard something else, that there's a good chance that Gary Gensler, the current chairman, will do what Elizabeth Warren wants because he might be tying his political ticket to her. Like if she runs for office, then he might be the Treasury Secretary or something like that.
He wants to be the Treasury Secretary.
Okay.
I don't know if he makes it or not, but I think he's really hurt the digital economy. I think he's set back the United States unnecessarily. There's no reason to do this other than political posturing.
So do you have any hope that we get a spot ETF with the current administration, and particularly Gary Gensler, or do you think we're going to have to push it off to a new person's in office?
No, I think you get the spot ETF because I think ultimately even Gary has capitulated and said that Bitcoin is a commodity and it'll likely be under the auspices of the CFTC. And since the CFTC has already approved a Bitcoin futures, my guess is they're gonna approve a Bitcoin Cash. Moreover, Grayscale, when they got rejected July 1st on their Bitcoin Cash ETF, they filed a lawsuit against the SEC. Remember, there's lots of checks and balances in our system, and their filing under administrative law says that you can't be arbitrary and capricious related to your regulatory response. So you can't. They're suggesting that it's hypocritical. You can't approve a Bitcoin futures ETF and then disallow a Bitcoin Cash ETF. They're too close for comfort for the rubric of our regulation, meaning how can you approve one and not the other? It's nonsensical. They're going to bring it before administrative judge. And I predict that the SEC will approve a Bitcoin Cash ETF before that judge's ruling, because I don't think they want to be embarrassed by that.
Yeah, I mean, it'll be exciting to see how it plays out. And recently I was reading that you have a new partnership with FTX. You were talking recently, I think you actually might even be going to the Bahamas this weekend to kind of solidify some of those deals. But for those of you who don't know, at Skybridge, I believe you guys are just north of 2.5 billion in AUM, and a large chunk of it, 800 million and maybe even a bit more now, is all going into digital assets. So out of all these well-known investment managers, I mean, Skybridge, you guys are very much focused on these alternative assets, particularly digital. And I know it goes beyond Bitcoin. We've interviewed some people, and not Bitcoin maximalists, but kind of there. But to my understanding, you're pretty supportive also of really Algorand, Solana, and Ethereum. Those are like the three other plays you watch, including Bitcoin. Mm-hmm. Is that right?
Yeah. I mean, I like Solana. I like Serum. I like even FTX's token, the FTT. We have a cross section of those securities in our coin fund, but by and large, our main fund, our sort of flagship fund, we have Bitcoin and Ethereum and Solana.
Are you concerned about the non-Bitcoin ones getting defined, like failing the Howey test, or I guess maybe technically passing it, but basically being defined as a security? Is that a risk to you, something that keeps you up at night?
No, because I think ultimately, if they are defined as securities, then they will be repositioned as securities. And I think that the use cases for these currencies, or whatever they end up being called, are still there. And I think they're going to proliferate. So I don't see that necessarily as bad. It could add added regulatory costs, which I think is unnecessary, but it's the life we live in, man. When you wake up in the morning, you're like, okay, I got to pay half of my money in taxes, and the government is going to try to block a lot of the things that I'm doing. Mm-hmm. They're well-intentioned. They're doing it to protect the consumer, and I understand that. But some of it is overreach, which hurts the consumer. But that's the nature of what we live with, and I'm fully capable of operating in that, and I've got the personality and the perseverance and persistence to do that. But that's probably where we are.
Awesome. To kind of get to the ending point of this talk, out of my own, I guess, maybe morbid curiosity of you being like truly like in the world of Wall Street, especially when this whole quote unquote retail revolution played out. You had GME, and then from there you had Doge, and then from there you had AMC, and then from there you had Shiba. Just like kind of these crazy, almost market cultural events where it was people who were just like kind of in on the movement. What was it like? Like, what was Wall Street saying about it? Like, I see so much of our side of very much a David and Goliath, Occupy Wall Street 2.0, just playing out on a different venue. What was it like? Like, what did you hear? Like, what was people's other hedge funds' opinions? Like, what did they say? Like, I'm just so curious.
So it's interesting the way you framed it as a retail cultural phenomenon, and so here's what I would say from the hedge fund community's perspective. It caused the end of Melvin Capital. Mm-hmm. So the Melvin got knocked out. They were short a lot of those stocks and they got burned. But I think more broadly from the hedge fund community, everybody was like, okay, wow, I want these retail customers to be cautious, because if you're in names that have poor fundamentals, and they're in declining, shrinking businesses, I would want those people to be cautious, and so what ended up happening was you had a bee swarm sponsored by Reddit, WallStreetBets. These guys said, okay, we're on to these hedge funds. They're trying to take out this company. Let's get on the other side of this thing and squeeze these hedge funds. And strategy worked. That's a good short-term trading strategy. But what I worry about is the long-term fundamentals of those companies. So I would just caution people, because there's a lot of Wall Street analysts, there's a lot of people that look at these companies' debt to equity ratios, look at the long-term growth of their businesses, and see those businesses in decline. So to me, I get it. The new technology, the proliferation of bulletin boards, and the proliferation of people being able to get together on the net to move something, I get that. And I think it is definitely a phenomenon. But I worry about it because I don't want this to end poorly for these people.
Yeah, that makes sense. I mean, I'm of the opinion, that Wall Street itself is one of the best vehicles man has ever made for really financial class mobility. Like we have not come up with a better tool ever to improve people's financial situation. So I just feel I too have like, you want people to have a positive, like you want it to be a positive experience, because if they get burned, they'll be like, no, I'm not going to create a retirement account. I'm just not going to be involved in it. When I definitely see what you're saying there. Like you want to be positive, and I think that comes back to, if people struck it lucky in one way or another, whether it's crypto or equities, is like, okay, focus on more of this long-term thing, like build the account, slowly add, and over time, a couple decades later, it's going to be way bigger than people would expect.
100%.
Awesome. I truly appreciate all of your insight. On your way out, if you just want to call out I'll get your Twitter handle and everything in the description of the video, but I believe it's at Scaramucci. Is that correct?
At Scaramucci is my Twitter handle. Also, we do a lot of commentary at Skybridge.
At Skybridge.
And so, but listen, I'm grateful for you having me on, and wish you a great weekend.
All right. Thank you so much. Have a good one. We appreciate it.